In this segment, I'd like to take the chance to talk about what many people consider to be the most important central bank in the world, the Federal Reserve System in the United States. As I mentioned in the last couple of videos, following the Panic of 1907, there was a strong movement in the United States to reestablish a central which could act as a lender of last resort. Unfortunately, they did not have such a thing during the Panic of 1907, and there was significant challenge in terms of coordinating a response. And as a result, there was a groundswell of political support for America to reestablish a central bank like it had had from 1791 through 1811, and again from 1816 through 1836. Now, in order to address the problems in central banking design, which had ultimately led to the failure of the first and second central bank, the Federal Reserve System was established on the basis of a compromise. Rather than there being a single institution that controlled finance across the entire country, what they decided to do effectively was to create 12 central banks. These are not all independent institutions, but they are effectively nodes in a network that works to coordinate activity between themselves. So what you have are the 12 Federal Reserve districts, each one of which has its own Federal Reserve Bank. Now, the Federal Reserve banks within each district get to advance the relative interests of their various regions and act effectively as a clearing bank for banks that operate within their particular regions. Now, some of these regions, you might say, for example, the entire Western region seems like an unusually large concentration. But you've got to remember that this was established in 1913, and these districts have not been updated. They represent roughly even amounts of economic power within the country and population divisions within the country, so that way some of the major regions, for example, in New England or in the lower lakes or in the Mississippi, could have a voice in policymaking at the national level. Now, the Federal Reserve acts collectively as the Federal Reserve System to complete the government's fiscal and monetary requirements. It runs the interbank payment system by connecting each of these 12 institutions to one another. It issues America's currency, Federal Reserve notes, and it acts as a lender of last resort to those banks who participate in the Federal Reserve System. In another nod to their Americans' concerns for concentrations of economic power, banks are not required to join the Federal Reserve System unless they are national level banks. So interestingly enough, what we find is that a little less than half of the commercial banks within the United States actually participate in this central banking system. National level banks, however, are required to join and of course thus comply with its regulations. Now, an important aspect of the Federal Reserve System is that the bank or the system itself is owned by the member banks who have chosen voluntarily to participate. And this, normally people think ownership constitutes the ability to make changes, right? If I own my house, no one's going to stop me from painting the walls. But even though these private banks own the Federal Reserve System, they don't have any of the powers that are traditionally associated with ownership. They can't even sell their shares. They can't vote to change the charter of the Federal Reserve System, which means they can participate in the profit that it generates, but they don't have control over how the system works. And that's an important distinction because you will often hear conspiracy theorists who are in a big hurry to tell you that the Central Bank of the United States is owned by private bankers, as though this somehow invalidated the design of the institution. It's worth noting that these participants only get a portion of the profits generated by central banking and instead remit most of it, as we're going to see, to the government. Now, if you do choose to participate in the Federal Reserve System, there are costs to play, but there are also benefits, most notably that you can borrow from the rest of the network should you find yourself in a liquidity crisis, and you have access to the Federal Reserve payment system. Now, one of the big things that it helps to improve financial stability within the Federal Reserve System is the ability of the federal district banks to lend money to one another. So if there happens to be, for example, a bank run happening in District 12, money can be transferred from all of the other districts to District 12 in order to ensure a proper functioning of the financial system. What we see here in this graph are tracking the balances within the Federal Reserve System of the different Federal Reserve banks making loans to one another. Money moves between these Federal Reserve banks through a payment system called FedWire. The balances of FedWire accounts are held in what's called the Interdistrict Settlement Account, or ISA. And that's what we're showing here in this particular graph, are the various ISA balances of different Federal Reserve banks. I've removed the labels down here because it's a little bit confusing for people to see, but it's worth noting, for instance, that we see huge balances in, for example, the Federal Reserve Bank of New York on a regular basis as it funds the cash needs of several other regional banks throughout the network. Now, what this really allows them to do is to move money around the country to where it is most needed. You'll notice, interestingly enough, that these balances tend to have what they call a zero date, where the accounts between the various central nodes needs to be cleared out. During the 2008 financial crisis, this was temporarily suspended, but you'll notice that we have moved back to a somewhat regular rebalancing of the ISA accounts. And this is to ensure that we don't have persistent imbalances with one part of the country necessarily financing another. The notion is that these are supposed to be short-term loans, not necessarily long-term financing. So let's talk a little bit now about the ownership of the Fed. As I mentioned earlier, the ownership of the Fed is held by the member banks who choose to participate in its system. So what's required for them to participate in this system? Well, every bank that wants to participate must buy in their membership. And when you do, you have to keep 10% of the deposits you receive on reserve at your local or your district Fed branch. Now, the membership cost, in other words, how much you have to pay, is proportional to the size of your bank. What they do specifically is they don't measure it by number of customers, they measure it by the amount of capital that your bank has. And you'll hopefully remember that capital is generally linked to this amount of assets that a bank has. The more it lends out, the more capital it needs to hold as security against it. Therefore, the more it lends, the larger percent of its, the larger the cost of its membership. And this means that small little community banks who want to participate in the Fed network don't pay extraordinarily high costs, but national level banking behemoths like Citigroup, for instance, or JP Morgan would pay substantially more for their memberships. Now, the funds that have been invested, what you get for buying your membership, is 6% a year on your capital contributions. Everything above and beyond that 6% on your capital contribution is handed over to the US Treasury. Now, you might ask, how much is that? In 1999, that was 98.9% of the profits of the Federal Reserve System. The member banks in total were only paid out $600 million out of the $55 billion that the Federal Reserve System generated in terms of profits on the payment system and on seniorage. So while you'll often hear uninformed YouTubers carrying on about how private banks are looting the Federal Reserve System, in fact, it is a cash cow for the federal government, which in turn spends this on a variety of different social programs that people benefit from. So the idea that private banks have an overwhelming amount of influence or are extracting extraordinary profits from the people of America is simply misguided and ill-informed. It's worth noting, in fact, that even in 2015, the Fed reduced the dividend payments for enormous banks. Right? This way, most of the Fed's profits that were being paid out were not necessarily being paid out just to large giants, but were focused a little bit more on a proportional basis on the participation of smaller banks. Now, unlike many central banking systems, the Fed is actually required to charge its members for access to the payment system, at least enough to recoup its costs, obviously, and run it as a business. This is designed to encourage competition and innovation in the market. In other words, the Fed can't simply sit back on its laurels and know that it has the only payment system and therefore watch it slowly wither and become less and less efficient over time. Because there are potentially competing payment systems, this forces the Fed to continue to innovate and to try to maintain the currency of its payment system with new technological improvements. So now that we know how the money works in the Fed and we have some idea of who actually owns it and what that means, let's talk about something a bit more substantive, which is who actually controls the policies made by the Federal Reserve Bank. Policy making and market supervision and regulation is the responsibility of the Board of Governors. The Board of Governors is made up of a panel of 7 government appointees who are nominated in staggered 14-year terms. So every 2 years, a new governor is appointed. So this Board of Governors, 7 people, works closely with the presidents of the district Federal Reserve banks. Within each Federal Reserve bank, every bank that participates gets 1 vote. So whether you're a national level bank that happens to be domiciled in District 3, or you're a small unit bank that's registered in Unit 3, you get the same amount of voting power for deciding who your local president is going to be. Now, the presidents of the federal district banks rotate through a series of positions in order to create what's called the Federal Open Market Committee. At any given time, among the 12 district heads, 4 of them are selected and go on rotation through the various districts. Given the importance of New York as a financial center, the president of the Federal Reserve Bank of New York always sits on the FOMC, along with all 7 governors. The other district heads, even though they might not have voting powers at the FOMC, are all entitled to speak at the FOMC and contribute research to the policymaking body. They can participate in the meetings, they can participate in the discussions, but they don't have the opportunity to vote. Now, while this may be a problem for, say, the Federal Reserve Bank of St. Louis, while it's not in control, the idea is that they do rotate through on a regular basis, so each region within the country does get to have a say in what exactly policies are going to be. But it's worth noting that the FOMC has 12 members, and that a full slate of governors, if the government had a full set of appointees, which it doesn't at the moment, that the government appointees would be able to overrule the presidents of the Federal Reserve banks, because the FOMC is ruled by a simple majority vote. And that means, of course, that even though there is an opportunity for the member banks to have a say in what happens and to help provide some insight into economic conditions in their various districts, they do not have the ability to override the government. The government in the United States is firmly in control of what the policies are going to be at the Federal Reserve Bank, despite the notion that the Federal Reserve System is owned by private member banks. Now, one interesting aspect of the Fed is that it has become, to some extent, the most important central bank in the world. The reason for this is largely because of America's economic dominance in the 20th and 21st centuries, but it's worth noting that in their capacity as the most important central bank, they have actually acted to provide somewhat what we might otherwise describe as global central banking stability, in the sense of providing international liquidity to other central banks who found themselves experiencing difficulties during the 2008 financial crisis. It's interesting to note that these were not called loans to other central banks, which would have been politically difficult to justify to their own citizens, and instead were described as central bank liquidity swaps. If we take a look at more specific statements that were made on this, for example, by the New York Federal Reserve Bank president, he states very clearly back in 2010 that these central bank liquidity swaps are designed to improve liquidity conditions in global money markets and to minimize the risk that strains abroad could spread to US markets by providing foreign central banks with the capacity to deliver US dollar funding to institutions within their jurisdiction. So the notion here of the American central bank providing international liquidity is less surprising than it might seem on the surface. While the average American might wonder why the US central bank would lend money to the European central bank during a crisis, and any good economist would recognize that problems don't stay within borders. And the central bank in the United States appears to have recognized this during the height of European instability and the global financial crisis. So in this sense, we see the US Fed acting to provide ballast to the international system, as opposed to simply the domestic financial system that it regulates.